Imagine waking up one morning to discover that a company linked to one of the most talked about families in America, backed by the sons of a former president, just lost nearly $1 billion in value. That's what happened on December 2nd, 2025, when American Bitcoin Corporation, ABTC, shares plunged almost 39%, in what many are calling one of the most dramatic crashes in the crypto equities world. The IT wasn't a technical glitch or some obscure accounting error. It was a classic case of a crypto meltdown meeting a post-lockup rush. Early investors in ABTC were suddenly allowed to sell shares that had been off-limits until now, a lockup period tied to its private placement ahead of its public debut. The flood of unlocked shares hit the market just as confidence in the broader crypto sector was already shaken. The sell-off was swift and brutal. At its worst point, ABTC lost more than half its market value in under 30 minutes, with trading repeatedly halted due to intense volatility. By afternoon, the stock had recovered a bit, but still ended down nearly 40%. This crash wasn't happening in a vacuum. The broader cryptocurrency market is in brutal crypto winter mode. The biggest digital currency, Bitcoin, BTC, has plunged more than 30% from its October high, dragging down nearly every crypto-linked company regardless of their actual business fundamentals. Even though American Bitcoin recently reported positive results, net income of roughly $3.5 million on revenue of about $64.2 million. Those earnings weren't enough to offset investors' fears. The panic selling suggests many are treating ABTC not as a mining company trying to build long-term value, but as a speculative proxy for Bitcoin itself. So why should you, as a US-based investor or crypto observer, care about this crash? Because ABTC's collapse is a microcosm of the bigger risk that looms over the industry. When crypto prices fall, those too good to be true public companies tied to mining or crypto treasury holdings can implode fast. What once looked like a bold new way to invest in Bitcoin without buying coins can suddenly turn into a fiat-denominated disaster. And here's the most important takeaway. Liquidity events, like lockup expirations, often create the greatest danger, sometimes more than macro trends or Bitcoin's price swings. For investors chasing hype in crypto-linked equities, those lockups are often the trigger for a broader unraveling. If you want to stay ahead, always check not just the current business performance, but the lockup schedule, treasury exposure, and how much of the company's value depends on BTC's price. For firms like ABTC, those variables make or break everything overnight. And if you like deep dives like this into major crypto equity moves and want to understand how they may ripple into your portfolio, subscribe and hit the bell, because we bring you these breakdowns right when they happen.